Let's review chapters 21 and 22. So our first question here, we're going to be dealing with the production cost report. We're told that the sanding department of Castle Company has the following production and manufacturing cost data for January 2020. And that's the first month of operation. Now that's going to be important to us once we start preparing our production cost report coming up. Then we're given some information, right? We're told some production data. 7,000 units were finished and transferred out. And those 3,000 units that were started, they are 100% complete as to materials and 20% complete as to conversion costs. And then we're given some manufacturing cost data. We're told that our materials cost $33,000, our labor cost $21,000, and our overhead costs $36,000. So with all of that information, we can now prepare a production cost report. So we have our data there over on the left and our blank production cost report here on the right. The first pieces that we're going to fill in here is under the physical units column for units transferred out, right? Because we're told that we have 7,000 units finished and transferred out. So we can toss that 7,000 in there. Now we can also put the 7,000 across the three different columns here for not only the physical units, but also for both materials and conversion costs. Because if these were transferred out, that means that these units were completely finished. So 100% complete for both materials and for conversion costs. Now, our ending work in process. We're told that there's 3,000 units there, right? The units that we started, but we just haven't finished them yet. So under the physical units, we'll put the full 3,000. Now our next two columns, you'll see above where it says materials and conversion costs, it says equivalent units, right? Because in these next two columns, this is how we solve for the equivalent units for our production cost report. So our ending work in process for materials, what we'll do is we'll take the 3,000 physical units that we have and we multiply it by the percentage that they're complete as to materials. So 3,000 times 100% will just be 3,000 again. Now for conversion costs, it's going to be a different number, right? Because our conversion costs, our ending work in process is just 20% complete for our conversion costs. So we take our 3,000 times our 20% and we just get that 600. Now, if we take a look at the section right above this where it says units to be accounted for, and we have our work in process for the beginning of the month, we're going to toss a 0 in there. And the reason why we throw a 0 in there is because we're told that this is the first month of operation for this department. So when we started the month, we didn't have anything in our beginning work in process. Which means that how many units did we start into production? That would have been all 10,000. All 7,000 that we finished and transferred out, plus the 3,000 that we've started, but just haven't completed yet. All 10,000 of those units had to have been started this month. So our total units, we just add up our beginning work in process and our started into production. And then if we take a look at the total units under the units accounted for, we take our transferred out plus our ending work in process. So 10,000 under physical units, right? Those two amounts will equal. Those two 10,000s that we have under the total units will be the same amount whenever we're doing a production cost report. Now the next two columns, the amounts that we're going to be getting here are the equivalent units that we need once we move into the cost section of our production cost report. So we take the 7,000 plus the 3,000 under the materials column, and we get 10,000 again. And for conversion costs, we take the 7,000 plus the 600, and we get 7,600. And then you'll notice under our equivalent units in the next section, we put that 10,000 and the 7,600 that we just solved for. So that top portion is all about number of units, right? Now we're moving into the cost section. So this has to do with money, right? How much did our materials cost? How much did our conversion costs cost? So our materials, we were told that those were $33,000. So we can just throw in the 33,000 there. Our conversion costs, those are the costs associated with turning raw materials into a finished product. So those are your labor and your overhead costs. So we take the 21,000 for the labor and add in the 36,000 for the overhead, and we get $57,000. Now we can add across there and see that the total for both materials and conversion costs equals 90,000. Now we've already filled in our equivalent units row. So our next row is our unit cost, right? So we're going to take the total cost amount, divide it by the equivalent units amount for our materials and for our conversion costs. So 33,000 divided by 10,000 tells us our materials cost $3.30 per unit. Conversion costs, we take 57,000 divided by 7,600, and we see that those are $7.50 per unit. So then we add those two together, and we see that one completed finished unit will cost $10.80. Now we move down to the cost to be accounted for, and we see our beginning work in process again. Well, our beginning work in process didn't have anything in it, right? This is the first month of production for this department. So we didn't have any cost associated with our beginning work in process, which means that all $90,000 of these manufacturing costs happened this month. So we throw that 90,000 into started into production. 0 plus 90,000 gives us our total cost amount of 90,000. Now we can move on to the last portion of our production cost report, the cost reconciliation schedule. So the first thing that we need to figure out is the cost accounted for our units that were transferred out, right? So we transferred out 7,000 units. Each unit costs a total of $10.80. So we take 7,000, multiply it by $10.80, and we get $75,600. Now we're working with our ending work in process, and we split that up between materials and conversion costs, right? So this is when we take a look back up at our units accounted for in our ending work in process for materials and conversion costs. For materials, there were 3,000 units. Each unit of materials cost $3.30. So 3,000 times $3.30 gets us $9,900. And then for our conversion costs, we see that there were 600 units, and each unit cost $7.50. So 600 times $7.50 gets us $4,500. We add those two together to see that the total cost in our ending work in process is this $14,400. Then we have one final line, right? Our total cost line. So we take the 75,600, add in the 14,400, right? The cost from our transferred out plus the cost from our ending work in process, and we get $90,000. Now we see 90,000 a few different places. We see it everywhere that it says total cost. So whenever you're preparing a production cost report, your total cost amounts will always equal. You're going to have the same values in those three pieces of your production cost report. Now, question number 2 is going to ask us to prepare a CVP income statement and to figure out the break-even point in both units and in dollars. So the information that we're given is that Billings Company has the following information available for May 2020. We have a unit selling price, unit variable costs, total fixed costs, and number of units sold. We can use that information now to prepare this CVP income statement. So let's just take a look at the framework of this statement, right? Over on the left, we have our sales minus our variable costs to get what's called the contribution margin. And then we subtract out the fixed costs and we get our net income. Right, so a fixed cost is something that will not change based on how many units you sell. It's going to be something like maybe the rent that you pay for your factory. A variable cost is going to be a cost that is dependent on how many units you sell or how many units you produce. Right, so maybe that's the cost of the materials that you need in order to produce units. So that's going to be your difference there between your variable and your fixed. Your fixed will remain the same all the time. Your variable is going to fluctuate. So then we can just plug in the numbers that we're given, right? Our unit selling price. So we put that under the per unit column, and we put the 400. Unit variable costs, that's $280. And then our total fixed cost, that's $54,000. Our units sold, we're going to use that to help us figure out our total sales and our total variable cost. So your total sales, we take the selling price per unit, right, the $400, and we multiply that by the $600 or the 600 units that we sold. So $400 per unit times 600 units tells us that we made total sales of $240,000. So we can put that into the total column. Variable cost, we're going to follow a similar pattern here, right? We take the unit variable cost, multiply it by the number of units that we sold, so 280 times 600, and we see that our total variable cost is $168,000. So we can use our total sales and our total variable cost to figure out our contribution margin, right? Sales minus variable give us our contribution margin. So 240 minus 168 gives us this contribution margin of $72,000. Then we can subtract out our fixed cost of $54,000 to see that we made a net income of $18,000. So we've figured out the total column on this CVP income statement. Then we take a look at the per unit. The per unit is only going to go as far as the contribution margin. And your unit contribution margin is going to pop up later on when we're trying to figure out break-even points. So to find that unit contribution margin, what we're going to do is we're going to take our unit selling price and subtract out the unit variable cost. So 400 minus 280, and we see that our unit contribution margin, or our contribution margin per unit, is 120. Then we have our ratio column, because we also sometimes use our contribution margin ratio when figuring out a break-even point. Our ratio is always in comparison to sales. So there's a few different ways that we can do this. We can take our total amounts or we can take our per unit amounts. Let's just take our per unit amounts here. So the ratio for sales would just be the 400 divided by itself. So sales will always just be 100% of itself. For variable cost, we'll take the 280 and divide it by 400, and we'll find that our variable cost ratio is then 70%, meaning variable costs are 70% of our sales. Then our contribution margin. We can find the contribution margin ratio two different ways. We could take the 120 and divide it by the 400. Or we can remember the relationship between sales, variable costs, and contribution margin. Right? Sales minus variable equals contribution margin. So we could take the 100% minus the 70% to find our contribution margin ratio of 30%. So we could just subtract like that, or remember, you could also just take 120 divided by 400. Either way, you'll end up with this 30% as your contribution margin ratio. Now we can use that CVP income statement to help us now figure out these break-even points. Remember, the break-even point is the point of not making any money but not losing any money, right? You are breaking even. So, your break-even point in units. How many units do you need to sell to cover your costs? So the way that we do that is we take our fixed cost divided by our contribution margin per unit. So our fixed costs are $54,000, and we divide that by our 120. That was our contribution margin per unit that we solved for in our CVP income statement. So our break-even point in units will come out to be 450 units. So we would need to sell 450 units at $400 per unit selling price in order to break even. Once we sell our 451st unit, then we'll start making money. Now our break-even point in dollars. So what's our sales amount in dollars that we would need to make in order to break even? So the formula is somewhat similar. Once again, we take our fixed costs, but this time we're dividing it by our contribution margin ratio. So we'll take the 54,000, divide it by 30%. Now an important piece here is remember that 30% is 0.30, right? We want to turn that percentage into a decimal. So we take 54,000, divide it by 0.30, and we see that we need to make $180,000 in sales before we can start making money. Another way that we could have solved for that, we knew our break-even point in units was 450 units. And we know that our unit selling price is $400 per unit. So if we take our break-even point in units, multiply it by our unit selling price, we can solve for our break-even point in dollars that same way. Right? Because your break-even point is your break-even point. So those 450 units and the $180,000, they're related because they are both at that same point. Just one's in units and the other one is in dollars. Now our third question here is about margin of safety. So margin of safety is how far above the break-even point are you, right? How much of a safety net do we have? So this says that Harris Company sold 50,000 units for $20 each. The company's total costs are $800,000. we're going to figure out the margin of safety in dollars and the margin of safety ratio. So, first, our margin of safety in dollars. We need to figure out our total sales. So our total sales will be the number of units that you sell times your unit selling price. So we sold 50,000 units, and we sold each of those for $20. So 50,000 times 20 gives us a total sales amount of $1 million. Our margin of safety in dollars is our sales minus our break-even point. So our sales were $1 million, and notice that our break-even point is the same thing as our total cost. Because if we remember, our break-even point is just how much do we need to sell to cover all of our costs. So 1 million minus 800,000 tells us that our margin of safety in dollars is $200,000, because we're $200,000 above our break-even point. Then our margin of safety ratio. We're going to solve that by taking our margin of safety in dollars that we just found and dividing it by our sales amount. So our margin of safety in dollars was $200,000. We plug that into our ratio formula. $200,000 divided by our $1 million in sales tells us that our margin of safety ratio is 20%. Now our last problem that we're going to be going over in this review, it's this high-low method. We can use the high-low method to help us figure out the variable cost per unit and our fixed cost amount. So we're given some information here for the first 5 months of the year. We're told for each month the total cost and the total number of machine hours. So we call this the high-low method because we're looking for the month with the highest and the lowest output, right? So your variable cost per unit formula will be the change in total cost at the high activity level versus the low activity level. And then we divide that by the high activity level number of hours minus the low activity level number of hours. So let's work through this and then maybe it'll make a little bit more sense, right? So we first see that the highest activity level is here in March. We had 700 machine hours. The lowest is there in May. That was when we had 300 machine hours. So our formula, the way that we're going to plug that in is we're going to take March's total cost and subtract out May's total cost, right? So the cost from the high activity level minus the cost from the low activity level, and divide that by the number of hours in March minus the number of hours in May. So once again, the high activity level minus the low activity level. That simplifies down into $2,500 divided by 400 hours, and we get a variable cost per unit of $6.25 per hour. Now we can use that information to help us figure out our fixed costs, right? Because our total cost would be our variable plus our fixed. So if we just take a look at March, our total cost was $5,500. Our variable cost would be the number of machine hours, our 700, multiplied by our $6.25. And then we could just solve for fixed cost using algebra, right? So our total cost is $5,500. Our variable cost comes out to be $4,375 plus X plus our fixed costs. So we subtract $4,375 and we see that our fixed costs equals $1,125.